first talk about corporate data reporting. Investors' ability to integrate ESG metrics into their investment process and ability to report sustainability status of their funds has always been constrained by availability of ESG data. This could see some improvement in 2024 as regulators in most geographies are pushing more and more companies to compulsorily report ESG data.
Welcome to Point Analytics Unplugged, a podcast aimed at delivering valuable insights into the ever changing realms of technology and business. Our goal is to provide our listeners with the latest trends and expertise in various fields, including data analytics, AI, finance, and ESG. I am your host, Supriya Praveen. In today's episode, we are excited to have Ajay Jindal, the lead solutions architect for DPA's ESG practice. Ajay holds over 2 decades of experience in research and analytics. He brings his extensive cross sectorial exposure to DPA's ESG practice. He is also a certified ESG professional from the CFA Institute. And it's worth mentioning that Ajay is our most frequently invited guest. Ajay, it's always a pleasure to have you here.
Thank you.
You, your,
Yeah, thanks, Supriya.
your enthusiasm and passion for ESG topics is truly inspiring. Today, Ajay will share his insights on another intriguing subject, key ESG trends for asset managers in 2024, as observed by DPA's ESG team. Welcome, Ajay.
Yeah, thanks again, Supriya. So yeah, looking forward to discuss the likely ESG trends, key trends that we see for asset managers for 2024. But before we go there, let's quickly recap what happened in 2023. So as you know, last year was another tough year for ESG. The backlash that had started in 2022 with the Russia-Ukraine war continued in 2023, particularly in the US, where a third of the states took a stance against ESG. And this impacted the freedom of pension funds from these states. It also slowed the progress of US SEC's ESG disclosure regulations. Separately, articles appeared in global leading media outlets asking for an end to ESG. Some leading global asset managers who had earlier taken a strong position favoring ESG and had set net zero targets for their portfolios also took a nuanced step backwards.
Ajay, as we move into 2024, what can asset managers expect?
At DPA, we think some of these negatives could gradually correct as we move forward. And we see several areas where positive developments can be expected this year. So let's first talk about corporate data reporting. Investors' ability to integrate ESG metrics into their investment process and ability to report sustainability status of their funds has always been constrained by availability of ESG data. This could see some improvement in 2024 as regulators in most geographies are pushing more and more companies to compulsorily report ESG data.
Can you highlight some key trends in corporate data reporting?
Yeah, so as you know, the European Union, EU for short, is the flag bearer of global ESG movement. In the EU, companies coming under the Corporate Sustainability Reporting Directive, or CSRD, which is a new thing sort of getting implemented, they will need to start reporting sustainability data as per European Sustainability Reporting Standards, or ESRS, from 2024. Now, this is a wide-ranging measure. The CSRD is expected to impact nearly 50,000 companies, including non-EU companies that have operations in EU above a certain threshold. It will also require companies to report more data compared to the existing NFRD regime. So for example, under environment, companies will need to report on water resources and biological diversity or biodiversity. Under social, again, there are more data points around diversity and working conditions. Now coming to US, in the US there has been a delay in uh, progress of regulation. The final adoption of Regulation 331104, which goes by the title the Enhancement and Standardization of Climate-Related Disclosures, it's finally expected to come through in 2024. This regulation aims to enhance and standardize climate-related disclosures. Uh, a, a discussion paper was first released by the US SEC in as far back as March 2022, but the final rule adoption has been delayed due to the anti-ESG sentiment in the US. The SEC is now expected to release the final rule in April 2024. Similarly, in terms of the other geographies where DPI is active, like Canada, there again we could see some uptick in mandatory reporting. For example, federally regulated financial institutions in Canada, including banks and insurance companies, will be required to start ESG reporting in 2024. The Canadian corporate regulator appears to be waiting for the US SEC to take the lead in mandatory ESG reporting. So if this US regulation that we just talked about goes live in April 24, it could have a ripple effect in Canada as well. So overall, we think as far as reporting goes, we can expect some good progress in 2024.
That was a very comprehensive explanation of corporate reporting. What can we expect in terms of funds flowing into ESG? Flows into ESG focused equity funds, whether active or ETFs, index funds, reduced in the last couple of years as these funds underperformed broader indices that included non-ESG stocks like fuel. Uh, Non-ESG stocks like fossil fuels companies or weapon makers. What do you see in 2024 for ESG funds?
Yeah, so much of the backlash against ESG comes from exactly this thing that the investment strategies based on ESG have underperformed in the last couple of years. We think that phase may come to an end in 2024. At least the trends on the fossil fuel side look good. So crude oil prices are expected to soften in 2024 due to higher production in the United States, as well as concerns about soft global demand. Also, let's not forget that the pressure to end fossil fuel use has gone up. The last United Nations Climate Change Conference, or COP28, that happened in December 23, concluded with an agreement that signals the beginning of end, as they say, beginning of the end for fossil fuels. Producers of fossil fuels, whether companies or countries, are aware that they are bound to make deep emission cuts. So it is likely that the phase of outperformance of fossil fuels has run its course. Now, defense stocks may continue to boom for some more time, given that global conflicts have only increased. Overall, we believe at some point in 2024, ESG funds and ETFs, ESG equity funds particularly, and ETFs will start looking good once again. Now, I emphasize the equity fund part of it because if you look at the data, fixed income funds have actually done well even in 2023. A recent document by Western Asset points out that ESG labeled bond funds grew their assets by 5.2% over 2020 in 2023, as compared to about 4% for the overall fixed income category. So, in other words, fixed income funds outpace their asset class. And as you know, green bonds, which is a subcategory of ESG funds, uh, experienced a very strong growth and it grew 30% year on year last year.
Interesting. We've talked about the fund space and the issuer space. What can be expected in the ESG seller space?
Yeah, so this is where things get a bit interesting, and we think there's a bit of disruption likely in the months ahead. As you may be aware, there's been widespread discontent amongst users as well as issuers against the methods and practices of ESG sellers. And this was beginning to boil over in 2023 to the extent that regulators started to get involved. So last year, the European Commission and the Norges Bank, which is one of the biggest sovereign funds in the world, expressed strong views on shortcomings in the ESG seller space. Norges Bank issued a statement wanting ESG rating providers to publicly disclose their methodologies, data sources, and other details about their methodology. The European Commission has proposed a regulation to improve the reliability and transparency of ESG ratings. It wants them to reduce conflicts of interest and increase integrity. Now, this proposal may become a ruling in 2024, and if this happens, we expect disruption in the rating provider business. Why am I saying this? Because we saw evidence of this in 2023. The Indian market regulator, which is SEBI, or Securities Exchange Board of India, now that has been very active in the ESG space. It has been shaking things up. So in the middle of last year, it published a proposed regulation where it wanted to regulate ESG rating firms. And in response, we saw some leading global rating providers. They stopped publishing ESG ratings for the Indian market. Now, this is a serious disruption because we have indices in India which are using these ratings by service providers as a basic input. And so this really disrupts the investing business. And so the seller space could see some interesting developments. Particularly, there could be disruptions in the business models.
It appears that the ESG market is going through some evolution. Any other interesting trends that you might want to close with?
Yeah, one interesting thing we think can come up is what we call evidence-based investing, particularly with respect to climate criteria. So we heard a lot of this talk of greenwashing and so on, right? And even regulators have been pushing for more data to address this issue. So as far as investing goes, the practice so far has been about relative comparison, ranking-based investing. We think asset managers will increasingly analyze direct evidence of ESG action from companies, particularly with respect to environment KPIs like GHG emissions or waste and water related management. And they are likely to get more information in the public domain due to some regulatory changes. So, so as you are aware, large companies in most leading economies have issued net zero targets now. Several of them are working with external outfits like SBTI to get their net zero targets validated. Companies are also beginning to report portion of their capex that is designed to reduce emissions or for environmental objectives around waste reduction or better water management. So the EU taxonomy regulation, which 2020/852, and the associated technical screening criteria, these are part of this regulation. They are driving a very interesting reporting change. This regulation requires companies to report extremely specific data on how their business activities align with climate objectives. So companies are expected to report on the percentage of turnover, percentage of capital expenditure, and operational expenditure that is taxonomy eligible and aligned. So this is new kind of data, and we think this will certainly start featuring in investment analysis. So, and with this kind of developments, we think the possibility of greenwashing could come down. So, those are some key trends that we went through, Supriya, and hope it will be interesting for our listeners.
Yes, definitely. There appears to be a lot of exciting actions for ESG minded asset managers, and they can look forward to it in 2024. Thanks, Ajay, for sharing your views on trends in the ESG asset management space for 2024. It's a lot of learning for me as well. All the podcasts give me a lot of learnings, first-hand learnings. As we come to the end of the episode, I want to express our gratitude to all the listeners for your attentive listening and look forward to connecting with you on the upcoming episodes of Decimal Point Analytics Unplugged. Thank you.